So financial assets and financial liabilities, and so this is a new chapter that we are beginning with, financial assets and financial liabilities. Very interesting, complicated, but can be simplified and can be high scoring also. Once you understand the logic, it's a smooth chapter. Okay. Now tell me, which standard covers accounting for debtors or account receivables? Do you recall any standard that deals with accounts receivable?
Not sure, sir.
Not sure. Okay. Then how do you classify preference shares, whether as equity or debt?
Preference is equity.
Equity. Okay. So these are things what we have learned as our earlier accounting standards and all of that, but then there is one important concept that is called substance over legal form. Preference shares, these are equity or owner's money, correct? But now if you look at Indian context, for example, preference shares have to be mandatorily redeemed, correct or not?
Yes.
Preference shares have to be mandatorily redeemed. Now if you have to redeem something mandatorily, then how can I call that person an owner? See, owner is someone who should be the last one to exit. But then one side I am saying owner should be the last one, or equity is the residual interest. If you look at the balance sheet, you will have assets, outside liabilities, and equity or owner's fund. Now owner's fund should be the last one that we should be repaying, but then I am saying there is an owner which is called preference shares, which I have to repay earlier. So what IFRS or what international accounting standards say is that in such cases you have to look at the substance of the transaction and not the legal form. See, the legal form is what? Legal form is that preference shares is owner's capital. But then what is the substance of the transaction? Within 5 years you have to repay the preference shares, or within 10 years you have to repay the preference shares. Then is it something not like a loan? That is what we need to examine and account for it under IFRS or under the international accounting standards, right? So this standard that talks about financial assets and financial liabilities is very important for us to determine what should be classified as assets and what should be classified as liability, and this deals with specifically the part related to finance. See, entire financial reporting is with finance only. Now inventory, if you see, you have Ind AS IAS 2, property plant and equipment you have IAS 16, for intangible assets you have IAS 38. For all these assets you have a separate standard governing them. But then when it comes to assets related to money, for example, if you have account receivable is what? Somebody has to pay you cash. When I say account receivable, somebody has to, we have to receive cash, okay? Or if you have made some investments, you will receive cash in future at some point of time, correct? Then you have payables, you have to pay cash. Wherever money is involved or related items are involved, those are covered in these topics of financial assets and financial liabilities, right? So here we'll understand what are financial assets, what are financial liabilities, and what is the meaning of equity. These are the three things we will be looking at. And please remember, this does not deal with non-financial assets or non-financial liabilities like your inventory, property, plant and equipment and all of those things. Those are not dealt in by these standards. What is dealt in by these standards are the ones which deal with money or which have a direct involvement in money. When I say money, it begins with cash, right? So that is what is the a broader background of financial assets and financial liabilities. Now what we will cover here is what are financial assets, what are financial liabilities, what is equity and debt. Okay, so these classifications is what we will understand, and all of these are called as financial instruments, and the standard that we should be referring to most of the times that we refer to is IFRS 9. IFRS 9 deals with financial instruments. IFRS 9 deals with financial instruments. We do have other standards, which deals with the definition part and disclosures part. For example, IFRS 7, then IAS 32. Okay, these three standards are there, but largely we will be dealing with IFRS 9 only. Okay, now when we look at this standard, first we need to understand the meaning of something called as financial instruments. And please revise this chapter because this is the first time most of you are getting introduced to this particular topic. Okay. So, what is financial instrument? A financial instrument is any contract. So, first thing that we see here is it is a contract. So, there has to be a contract. So, when you receive money or when you would receive money, there has to be a contract. For example, a sale transaction. A sale transaction is a contract. Contract may be written, oral, implied, whatever it is, but there is a contract. So, under a contract that gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Now, here we are saying there is entity 1, there is entity 2. Okay. Assume for a moment entity 1 says, I have trade receivable. I have trade receivable. What is a trade receivable? It is a financial asset. Now, this financial asset should be a financial liability or equity of another entity. Now, entity 2 says, I have trade payable. This is a financial liability. Okay. Or entity 1 says, I have invested in equity shares. This is a financial asset. This is an investment, it's a financial asset. Entity 2 says, this is my equity share capital, which is classified under equity. So, there can be one entity or more than one entity, but normally we can understand this using two entities. Entity 1 and entity 2 should have a contract. There has to be a contract. Oral, implied, written, whatever it is, there has to be a contract. And the financial instrument is a financial asset for one entity. So, if it is an asset for one entity, for another entity, it should be either a liability, a financial liability, or it should be classified as equity. Then that is called financial instrument, which will be covered in this particular standard, right. So, just to revise again quickly, a financial instrument is any contract. It has to be a contract that gives rise to a financial asset of one entity and a financial liability or equity of another entity. Now, there are lot of receivables which do not arise out of contract. For example, you have paid advance tax and that advance tax is refundable. Is there any contract between you and the government? There is no contract. Okay. So, such kind of cases, income taxes paid, payable, receivable, these cases are outside the scope of IFRS 9. So, if there is no contract in place, then that is not covered under financial instruments, right. That is one thing you have to keep in mind. Then, what is the background? I gave you a few examples, right. Preference shares. For that, we need to have proper accounting. For trade receivables and other related items, we did not have specific standards. Then, over a period of time, there has been a lot of growth in the market instruments. You have options, you have futures, you have derivatives, you have swaps, any kind of instrument you think of, and there is an instrument available in the market, right. So, wherever instruments are available in the market, because the volumes have gone up significantly. Some companies purchases copper, it enters into a forward contract to hedge the purchase of copper. So, on one side you are buying a non-financial asset, on the other side you are entering into a forward contract, which is also called a derivative. So, there was a lack of standard, there was no proper standard which had the authority to tell how should the accounting be done. That is where this question, this particular standard comes into the picture. It tells us how to recognize an asset, a financial liability, equity, how to account for them, how to subsequently measure. All of those things are covered in this particular standard. As I told you, 3 standards are covered, or we need to learn. IS 32, which deals with presentation. It also covers the definition part. Then IFRS 7 is the disclosures, and IFRS 9 is the core standard. Okay. So you cannot learn one standard independently of other. You need to understand all the 3 standards together. More we will be focusing on IFRS 9 after we understand the definitions in detail. Now, what is a financial asset? A financial asset is cash. Cash is always a financial asset. So, if you have money, physical cash, bank account, fixed deposit, all of that is cash. That's the first thing. Second, a contractual right to receive cash or another financial asset from another entity. Now, this is what you need to understand. Cash is a financial asset. If I have a right to receive, and it has to arise out of contract. If I have a contractual right to receive cash, or any other financial asset from another entity. So as I told you, trade receivable. What will the trade receivable give me? Trade receivable will give me cash. I have a contractual right to receive cash. So it's a financial asset. If I make investments in another entity and if I have a right to receive the cash back in the future, let's say it's a preference shares and I can receive dividends on periodically, I'm entitled to it, then that's a financial asset under this clause. Or if I have investments in, let's say, debentures or bonds and I will get interest periodically, that's also my financial asset. Okay, so there has to be a right to receive cash. Now, if I have made investment in another entity in equity shares, I don't have a contractual right to receive cash. So under this clause, I will not call it a financial asset. There must be a right. I can go and tell the other person, you have to pay me cash on these specific dates. Only then it will be covered as a financial asset in the second category. The third category is a contractual right to exchange financial assets or liabilities with another entity under conditions that are potentially favorable. So please mark this word, potentially favorable. What does this mean? This means that I have a financial asset or a financial liability. I can exchange that with another entity in favorable terms. Now for this, let us take an example. Say there is something called call option. Call option gives me right to buy. Call option gives me right to buy, but there is no obligation to buy. It gives me a right to buy, but there is no obligation to buy. For example, shares of Reliance. Okay, I have 100 calls. 100 calls means what? I can buy 100 shares of Reliance, 100 shares of Reliance at, let us say, rupees 1000. Okay, so I have entered into this contract under which, let us say, for example, you are the other party. I can buy 100 shares from you at rupees 1000, let us say, after 1 month. So after 1 month, I can buy how many shares? 100 shares from you at what price? 1000. For this, we have entered into a contract, right? Now assume for a moment, share price increased to 1100. Even if it increases to 1100, you have to sell to me at 1000 only, because that is the contract. Now tell me one thing, for me, is it favorable or unfavorable? Is it beneficial or is it not beneficial?
For you, it's not beneficial.
Why?
Because the price increase, but you have to sell at only 1000.
I can buy, that is what I have written.
Oh, you can buy, sir. Okay. So it's favorable for you.
Okay, I can buy. I said I can buy 100 shares at 1000. You have to sell. So if it is 1100, then this contract has become favorable to me, right? And it has become unfavorable to you. Okay, so here is where you are saying you are exchanging financial assets or liabilities. Now what am I exchanging here? I will give you cash, which is a financial asset. You will give me another financial asset, which is an equity instrument of another entity. I will give you cash, which is a financial asset. You will give me another financial asset, which is shares of Reliance. We are exchanging financial assets and terms are favorable to me. It is a financial asset for me. Terms are unfavorable to you. It is a financial liability. Okay, so more on derivatives, we'll come to it slightly later. I don't want to complicate it here, but then think of a situation where I can exchange a financial asset or I can exchange a financial liability with another entity under conditions that are favorable or unfavorable. So thing you have to remember here is, if I am exchanging assets under favorable conditions, it is a financial asset for me. If I am exchanging under unfavorable conditions, then it is a financial liability. Okay, so again to recap, a financial asset includes cash, a contractual right to receive cash or another financial asset, a contractual right to exchange financial assets or liabilities with another entity under conditions which are favorable, potentially favorable. See, as on date, we see the contract may expire later, but potentially it has to be favorable, and an equity instrument of another entity. All of these are called financial asset. So the moment you see a balance sheet, you see cash, financial asset, debtor, financial asset, investment, financial asset, derivative asset, what I gave you an example just now, we'll understand it subsequently. Financial asset. Investment in equity, financial asset. Investment in debentures, financial asset. Okay. Loans given, financial asset. Wherever you have a right to receive cash or any other financial asset, or to exchange under favorable conditions, or if it is an equity instrument of another entity, it is called financial asset. We understood about financial asset in the previous class. Now we'll move on to the next part, which is financial liability. Now, when you look at the definitions of financial asset and financial liability, there is a lot of linkage between these two. Okay. First thing, financial asset has cash. So cash is something which is cash in hand, cash at bank and all of that. Of course, there will not be anything related to this in the liability part, right? Because having cash cannot be a liability. So that part is not there. But the second part, which is a financial liability, is any liability that is a contractual obligation. So again, here we are talking about contractual obligation. There has to be a contract and there is an obligation. What was here? Here it was an asset and it was a contractual right. Right. So coming back, a financial liability is any liability. So first it has to be a liability which is arising out of contract and which has an obligation. Now what is the obligation? The obligation is to deliver cash or another financial asset to another entity. So financial asset is what? Is a contractual right to receive cash or another financial asset. Financial liability is a obligation to deliver cash. So if you have to deliver cash, it is a liability. For example, trade payables. If you have to deliver another financial asset, that is also a liability. Now what is another financial asset? Say for example, I have some investments in a particular company. That asset I have to give it to somebody. So that leg of the transaction is a financial liability. Okay. Then second part, to exchange financial assets or liabilities with another entity under conditions that are potentially unfavorable to the entity. Under asset we understood, it is a right to exchange financial assets or financial liabilities in terms which are favorable to the entity. So whenever it is in my favor, whenever it is beneficial to me, it is a financial asset. Whenever there is an obligation, whenever there is a burden on me, it is a financial liability. So coming back to example that we took for financial asset, here we said, say for example, I have a right to buy. I have a right to buy what? 100 shares of Reliance at what rate? At rupees 1000. I have a right to buy 100 shares of Reliance after 1 month, and let us say you have to sell those shares to me. You have to sell those shares to me. Now, if the price goes to 1100, I can still buy at 1000. So if I can buy at 1000, when the market rate is 1100, it is beneficial to me, it is favorable for me, so it is a financial asset. On the other hand, for you, you have to sell it at 1000. If you wanted to go to the market, or if you could go to the market, you would have sold it at 1100. But then under this contract, you have to sell it at how much? At 1000. So that is potentially unfavorable to you. Okay. So if the contract involves exchanging of assets or liabilities which have terms which are favorable, then it will be called an asset. If it is unfavorable, it will be called a liability. So liability to deliver cash or another financial asset, that is the first part. Then to exchange financial assets or financial liabilities with terms which are unfavorable, potentially unfavorable, this is a liability. And third, that will or may be settled in entity's own equity instruments. Now here, one thing you have to keep in mind is this settlement has to be based on variable number of equity instruments. Now what do I mean by this? I'll just give a very simple example. Say entity A purchases a machinery. Okay, entity A purchases a machinery and agrees to issue shares in return. So the entity wants to purchase a machinery and they agree to issue shares in return, right? Now when shares are issued, there could be two ways to arrange this transaction. Say for example, today the machinery worth is rupees 1 lakh. Let's put 1 lakh. Okay, and value per share is, let us say, 100. So number of shares is 1 lakh divided by 100, which is 1000. Okay. Now, let us say in this arrangement, what entity says is, I have purchased a machinery is delivered, but I will issue equity shares, issue 1000 equity shares in future, let us say after 1 month. Okay. So, what has happened? Machinery has been purchased. Against that machinery, the entity says, I will issue how many shares? 1000 shares. When? After 1 month. Okay. Here also, what is happening? Here you will deliver equity shares. Another case could be, see, after 1 month, we don't know what will be the price. After 1 month, we don't know what will be the price, because price may go up, price may come down. So, the other party may say, see, if you give me 1000 shares after 1 month, I don't know whether I will get 1 lakh or not. So, based on the price existing on that date, you give me 1 lakh worth of shares. So, first scenario is this. Second scenario is issue shares of value rupees 1 lakh or 1 lakh. Okay. Now, when I say I will give you shares worth 1 lakh, the number of shares are not fixed. Okay. So, let us say if price is 125, then it will be 1 lakh divided by 125. If price is 90, then it will be, which is 1111, right. So, here the number of shares are not fixed. So, two things you have to keep in mind is, if it will be settled in equity own instruments. So, if there is a contract which will be settled in equity own instruments, meaning to say the entity has an obligation to deliver equity instruments, then in that case you have to see whether it is fixed or whether it is variable. If it is fixed, the number of shares are determined, then this is categorized as equity. If the number of shares are variable, this is classified as a liability, right. When we understand equity, you will have more clarity on why we are saying this is equity and this is liability. So, for now, if you have to give your own equity instruments, and if those equity instruments, the number of equity instruments are not fixed, then it will be called a liability, right. So, financial liabilities include, example are, one is trade payable. We have discussed yesterday. Trade payable, why? Because it is an obligation to deliver cash. Then debenture loans, again obligation to deliver cash in form of interest and principal repayments. Then redeemable preference shares. Now, this is the discussion which we had in the previous session also. Redeemable preference shares, if you have to redeem it within a specified period of time, there is a contractual obligation to deliver cash. There is a contractual obligation to deliver cash, and hence redeemable preference share is also classified as a liability. Now, why are equity shares not classified as liability? Because equity shareholders, to the equity shareholders, there is no contractual obligation to repay the cash. When I am saying that there is a redeemable preference shares, the underlying thing is the entity, the company has to pay back the amount after a certain period of time. There is a contract which creates an obligation to deliver cash to the preference shareholders, and hence preference shares are classified as, redeemable preference shares are classified as liability. If preference shares are irredeemable, then it is not classified as a liability, because there is no contractual obligation to deliver cash. Okay. So, any question in liabilities and asset? Because this is the core. If you understand this, then accounting is pretty simple, and one of the most difficult standards which students face. Any question, or are we good to go? Okay. Now, identify which of the following are financial instruments. Inventory, is it a financial instrument? I know, you can see the answer down below. Okay. Inventories are non-financial item, first thing. And when we say financial instrument, it has to either be a financial asset or a financial liability or equity. It has to be one of these three. Is it a financial asset? Do I have contractual right to receive cash from inventory? I don't have any contractual right. Okay, because inventory is lying there, until and unless I sell it, I will not get cash from that. So, it is not an asset. It is also not a liability, and hence it cannot be classified as a financial instrument. It is a non-financial asset. Okay. So, first one, inventory, it is not a financial asset because there is no contractual right to receive cash. Investment in ordinary shares. So, we have seen here as a part of the financial asset definition, an equity instrument of another entity is a financial asset. Equity instrument of another entity is a financial asset. So, investment in equity shares of another entity is a financial asset and hence it is a financial instrument. Then, prepayment for goods or services. Now, when you have made prepayment for goods and services, okay, now let me ask this to you only. When we make prepayment of goods and services, is that prepayment an asset or a liability?
Prepayment asset, sir.
It is an asset. Now, is it a financial asset?
Yes, sir.
How?
We have right to receive, we don't receive cash.
You don't receive cash. You don't receive financial asset. You receive goods. So, if you have done some prepayment where you do not have the right to receive cash, or as a part of the business practice, you know that the goods or services would be delivered, hence it is not a financial asset. Okay. Let us say now we give advances to employees, loans. We give loans to employees. Now, when we give loans to employees, if we recover it back as interest and principal, then it is a financial asset. But if it is a salary advance and we will not recover it by way of cash, we will only get services from the employee, it is not a financial asset. This distinction is very, very, very important. What are we getting in return? Are we getting financial asset? Are we getting cash? Then it is a financial asset. If we are getting a non-financial asset or if we are getting goods or services, then it is not a financial instrument. Okay. Then liability for income taxes. No, it is a liability. You have to give cash for that liability. But as we discussed in the previous class, there is no contract. When you are paying income tax to the government, you are not paying because of a contract. You are paying because there is a regulation, there is an act. And hence income tax payable is not a financial liability. Please remember, there has to be an underlying contract. As per that contract, there has to be a right or an obligation. Okay. So, it is not a financial instrument because the obligation is statutory and not contractual. Clear? And last one, share option. An entity's obligation to issue its own shares. Now, when you have an obligation to issue own shares, here you see, it may be settled in entity's own equity instrument, so it will be a part of your financial liability or equity based on the contractual terms. Okay. So, for now, what you need to understand is, I'll just summarize it here. Financial asset is cash. You hold cash. Then, cash or any other financial asset if you have right to receive. And here it is obligation to deliver. Then, exchange of financial asset or liability, favorable terms, unfavorable terms. And lastly, equity investments in equity if there is an obligation to settle in own equity instrument. Okay. Now, one more thing you keep in mind is, at this level we will not go into too much of depth. Okay. At the next level, when you learn financial instruments, that is when you will be tested in much more detail. Okay. So, now this is the summary of what is a financial asset and what is a financial liability. Financial asset, again, cash, right to receive cash or another financial asset. Favorable term settlement, you must be in profit, it must be beneficial to you, and investments in equity of another entity. All of these are financial asset. Just opposite to that is your financial liability.
Sir?
Yes.
So, in the second definition they are given a contractual right to receive cash. In all the definitions they are given from an entity, sir. So, if from an individual person, that's
entity. No. Entity means everybody.
Everybody. Okay, sir.
So, here when I am saying contractual cash to receive, right to receive cash, there can be a customer.
Okay.
There can be a firm, there can be a business, there can be a company, there can be anybody, but it can be government also, but it has to be out of a contract.
Contract. Okay.
Okay.